Jonathan Mickles with the Strategic Multifamily Investing Podcast. And I have with me today Mr. Aaron Chapman. I'm sorry, I said Adam Chapman. How's it going?
There's worse things to be called, and I've been called it by people very close to me.
I understand. Family can be something else. So listen, it's been a little while. Your team reached out to me and said, hey, we want to get Aaron on your podcast. And I said, I was just under it for a little while. So I'm glad that we're able to speak here a little bit more. Tell us a little bit more about, who you are, the company that you have, what you kind of do, and then we'll just dive right into it.
Sounds good. So I am just your regular mortgage guy, right? Some people will say that I don't look like a regular mortgage guy, but I've been at this since 1997, started in the broker world, came from the mines and running heavy equipment, welding in Wyoming in the oil fields, and I worked my high school years on a cattle ranch. Forrest got my way into this, and that's a whole story in itself. But I found the real estate investor coming into Arizona after the crash as becoming my main place of understanding and helping people build their wealth. And so I focused there. And so I've been working with real estate investors really since 2003, but really heavily since 2009 after my own financial and physical explosive situation because of the 2008 crash. And now we help thousands of people across the United States, as many as 100 transactions, actually 150 transactions a month for the real estate investor getting, and there's definitely the multifamily piece of it, but a person's trying to walk before they run. So we help them get into the single family, which my personal belief is can become the most valuable per square foot real estate on the planet due to what's happening with the hedge funds and your iBuyers and that kind of thing. So I'm with you, helping all those people out there that want to build long-term wealth and legacy and kind of layer that for the future. Because if we don't do it now, I think the rug's gonna be taken out from us at some point, and we're gonna lose that opportunity.
That's very interesting that you say that. I want to ask some more questions about that, but I want to go back to Forrest Gump. So you were doing heavy equipment operator stuff, your website said, and you said you Forrest Gumped your way into mortgages. I mean, that just doesn't seem like that's the pathway, if you will, for people to move from doing heavy equipment operation, oil rigs, things of that sort. What got you into this field?
Well, the reason I say Forrest Gump, because everything that happened in his world was fortuitous, right? He just kind of stumbled into it. And I was at an event one time where one of the keynote speakers used to have a mortgage company before the crash. He talked about being a person that worked in the mortgage industry as the reason you get in the mortgage industry is because you can't get a job doing anything else. And that was very true for me. So I grew up on a cattle ranch, then from there left high school halfway through my senior year to work in the oil fields of Wyoming for a welding company. From there, running heavy equipment, driving truck, and then I found myself in the mines of northern New Mexico, which in reality was the greatest job I've ever had. I absolutely loved it. You're several hundred feet underground. You literally have your day is pretty laid out for you. You got to drill a certain amount of holes in the rock. You got to load it full of explosives, step around the corner, blow it up, dig it out, support the ground, do it again. It's simple, but it's extremely hard. And you're the first person to see what's on the other side of that explosion, right? So it's kind of cool. Plus, it's just dangerous as hell. But the problem with that type of world is after a point, getting the ore from way underground to the surface becomes more and more expensive than what you can sell the ore for, depending upon what's going on in the market. So we're at a point where that particular ore dropped in value. So hey, we're going to shut it down for now, lay everybody off, and we'll bring it back when we can. I came back to the Phoenix area where I had a wife and infant son that I would be gone for 13 days, back for 6, gone for 13 days, back for 6. And I'm like, hey, I can get a job anywhere because I got a very, very long resume. The problem was my resume. I kept getting this statement every time I applied for something that I was overqualified. So it got to a point where it became very dire that I needed something because I was overdrawn on my accounts. I couldn't even afford to get diapers for my kid. And I was going to apply for a job I knew I could get, which was a $10 an hour truck driving job to haul landscape rock. I'm like, at least I will get this and I can put diapers on the kid and put some food on the table. I got that same bullshit response, overqualified. So I asked that guy at that time, I was like, what the hell does this mean? I can either do the job or I can't. I'm 23 years old. I don't get it. He said, that means that you have expertise enough that we would feel like you would leave us the second you found something better.
Right.
Like, okay, that makes sense. It doesn't make me feel any better, but it makes sense now. So as I left that place, kind of wiping tears from my eyes, I'm literally in a bad, bad, bad spot. And I get in my truck to drive to a grocery store to get some diapers. My wife gave me a coupon for free diapers. My gas light comes on in my truck. Had not driven very far with a gas light before on that truck. So I'm like, I just got to find the closest thing I can get. So I found a spot that I can pull into a location I can get some fuel and get my diapers. Run my debit card, hoping I get at least some clemency. Said a quick prayer, and I got a decline. So rifled through my truck, found a couple coins, locked the doors, and I started walking that parking lot for what seemed like a couple of hours. I found enough change to get 2 gallons of gas because, again, it's 1997. People carry change, and gas was 89 cents a gallon.
Yeah.
Then I walked into the grocery store with my coupon, found my diapers, and I'm walking out of there with my head down, ignoring everybody because I felt pretty damn bad. Well, I heard my name called. So I turned. It was a guy used to run an office where I ran heavy equipment. So I turned to him, faced him. He asked me how things were, and I was very, very vague, but he invited me to dinner. I explained to him, dude, I can't afford dinner. He goes, hey, I got a gift certificate to Red Lobster. And that was where he introduced me to the mortgage industry. He connected me with a guy that was starting me as a telemarketer. Well, I had to cut a foot off of my hair. I had to shave. My mom bought me some business-like clothes in December of 97. I got on the phone, was calling leads, and that's how I started. Now, take it fast forward 20 some odd years later, here I am. 2022, I was ranked number 7 in the United States for how many transactions I closed. Last year, I was ranked number 41, which is still in the top 50 in the United States. And it's just, we just keep cranking along. I'm number 1 in the real estate investor space for conventional lending, and I've got an amazing team.
Well, it sounds like it. It's a family team because in reading a little bit more about your bio, it seems like your entire family came together and said, "Hey, let's go and do something," and you put that together. And that definitely is
The family piece of it's a little different. So the team I've got only one family member that works on my team, which is my sister and my daughter do. Outside of that, I got 21 people total on my team. So yes, 19 of them are not family, but we're all very, very close. But the family piece of it is, as I'm building my real estate investment portfolio, if you will. I formed the family trust. I used infinite banking, and my children get involved in infinite banking. We as a family vote on what we invest in as a family. So if it all goes to shit, it's all our fault. But when I leave this earth, which I will eventually, and all that money pays out for my life insurance policies, they already know how to run it. They've already voted on it. They've already built it. And so they're not going to just take all the assets I worked my life off to build and just obliterate it and go do something dumb. They're going to keep it going for the future generations. Because if we don't take advantage of what we have today, the 2 generations after me, they won't have anything.
You're absolutely. I love everything that you're saying because I think what came to mind as you were saying that was I think Elvis, when he passed away, or some of the other major celebrities that are out there, when they pass away this entire $1 million, potentially multi-million-dollar portfolio, and then everybody just starts selling everything rather than knowing how the thing works and keeping it going so that they can continue to live and pass those things down and have additional equity, if you will, for other things that they want to do. So that's amazing. I always like to understand a little bit more about the backstory because people are who are doing these things, who are accomplishing these great things as you have with your company, are real people. They came from somewhere, and they're still going to some other place. I also read just one last thing before we just dive deep down into the economic stuff. That you and your wife, I think, retired from a fire department. You guys were EMT and paramedic.
The rescue unit for the sheriff's office. So I was with them since 2009 up until 2018. I ran what they call their technical rescue unit. So those are the guys that we get flown in, either sometimes rappel out of helicopters, get dropped off, and then it's setting up rope systems to pull people off cliffs or out of crevices. We've done cave rescues, rolled over vehicles, that kind of stuff out in the wilderness, right? So if you've got something like that, you can't just roll up a fire truck and cut people out of a vehicle. You have to learn how to cut them out with hand tools and handyman jacks and that kind of stuff. And so that's where I was in charge of that unit for I think 6 years total, and then she ran our medical director for the unit, and then I ran their off-road rescue unit. I started that in 2012 and ran that until I handed that off to another guy so I could focus on technical. But yeah, that was a blast. Once they started getting a lot more equipment, when the state was able to allocate more capital to these counties, and these counties allocated more capital, they didn't need us anymore. The human element of getting in there and setting up rope systems and pull people out were less necessary when you have a helicopter with winches on them and they can just go down into anything and pull things out. So we weren't getting the operational time any longer, and so I decided, it's time for me to retire and move on to something else. I wasn't moving on; I was still doing this, but just really, really focus on my business a little bit harder.
Got it. So let's jump right on into the economic stuff. Right now, at the time of this recording, we're in 2024, in June of 2024. And there's a lot of stuff happening. I've heard a lot of different things that are potentially going on. Give us the state of what you believe and what you see is happening right now economically.
Oh boy. Well, one, we all know we're getting jerked off. I mean, we're not getting the real deal of what's going on in the market. They've been cooking these numbers for a very, very long time. And when you look back, everybody thinks the thing that we're up against most is everybody's worried about when are the rates going to go back down to what's claimed to be a normal rate. Well, the problem is the majority of people who are in my industry, they're doing the real estate, your real estate investment gurus, they're talking about, hey, go buy your investment real estate. It was easy to buy investment real estate and be cash flowing when interest rates are 2, 3, and 4%. But when they're 7+%, now it's like, oh, let's wait and see if the rates go back down because the market's a cycle. That's not a cycle. I'm trying to help everybody understand that the cycles happen every 4 to 10 years, but they did when you didn't have the government's involvement. Now, what you do is you go back to 2008 and before, it was all humans' involvement in creating all this, but then you also had humans doing stupid crap, which was your no income, no asset loans, your high LTV investor loans, things like that, to the point where everything came crashing down. Then you have the Dodd-Frank Act, you have the formation of the FHFA, and all these other different organizations that says, we need to now protect the Consumer Financial Protection Bureau. So we got to protect the consumer from the finance industry who got really, really reckless with lending money, which we did. Now, why did we get reckless with lending money? When you have a government that says everybody deserves a house, you have a consumer that says, I deserve a house. And then everybody's saying, we want this. And then the mortgage industry says, okay, we'll create you something, but you're going to take it and you're going to like it. And they gave it to them. Well, then everybody all of a sudden uses it to their advantage, and their advantage is gone when the market crashes and everybody wants to blame everybody else. So who takes the fall? The mortgage industry. And who in the mortgage industry takes the fall? Let's find the one guy. And literally the market targeted one guy. They went after Angelo Mazzillo from Countrywide. Said, that's Satan right there. He caused it all, which he didn't. Like literally, he was the one independent guy who created the biggest entity on the planet. Now, was Countrywide culpable for some things? Yeah, but it was a small sliver of their business. It just happened to be the biggest chunk of that business in the industry. So everybody wanted to villainize them. Well, then you got Bank of America who swallows them up. Massive entity with $100 billion in assets. They swallowed up for $4 billion. That's kind of an interesting statistic too, as you start getting into this. Now, there's a lot more to it than what I know. I'm just on the outside looking in. They only show us so much. But what you start to see is, it makes you wonder how planned it could have been. Because when you consider we have a crash of 2008, and we have interest rates that were averaging from 1971 to 2008 on a 30-year fix, averaging 9.1%. Then you have all this liquid capital going into the mortgage-backed securities and into the treasuries and the corporate bonds from the U.S. Treasury, printing money, shoving it into the Fed being investing in all those places, making enormous amounts of liquidity available, $8.9 trillion to be exact, to bring down interest rates and stimulate the economy. Well, that not only stimulated the economy, if you will, but stimulated home purchasing to a level beyond anything ever seen in recorded history. Well, when you have that kind of an increase in purchasing and the affordability index was off the charts, people were willing then, if you remember, a lot of real estate agents would say, if you want your offer to be considered, you got to be willing to offer $30,000 to $50,000 over list, and then be willing to pay $100,000 over list to get the house. Well, what benefit was there if you got a low interest rate, if you're just going to prepay the value of all that extra savings in a higher price? So home prices jumped so much that there really was no benefit to the lower interest rate. But here's the problem. We just finished a crash. And when we finished that crash, builders stopped building. Inventory was not going onto the market to the extent that it was going to get used up. So now we have there's still a shortage of inventory.
Right. You were already at a deficit prior to. Yeah.
Exactly. Already at this deficit. You're not going to suck up all that inventory, even with all that kind of buying. More people got in the market than ever had been before because of the affordability. Now there's all these people with all these low interest rates that are not going to sell. So we still have this massive deficit. Prices are not going to reflect what's happening in the interest rate market. Our prices should be significantly lower based on where we are in rates. In fact, our rates should be actually higher than what they are today. Us being offered, look at bank rate 6.99 to 7.1% for your average homeowner. Okay. That's lower than what you see in the average from 1971 to today, which is 7.75. You take out what the federal government did, which is what they call quantitative easing, it should be 9+%. Let's just say down to 8%. That would be an average market. So what we have is 13 years of clouded history that people don't know what the market really should be. And they're waiting for something that will never happen. But at the same time, we're not going to see the price points adjust to the point where it would be palatable. Then you also throw on top of that, the hedge funds buying at an enormous pace. Last year, 44% of the single families sold to iBuyers or hedge funds or Wall Street. Well, it's also anticipated that those same entities can control up to 40%, if not more, of the rentals by 2030. What does that tell you?
So then let me go back and add. There was a lot that you shared. People are waiting for the rates to go down. I think that's what you mentioned. And you're saying rates are not going to go down. They should actually be higher. There's a lot of, am I correct in saying that? Let me make sure I'm understanding.
That's now, it doesn't mean they're going to go higher. It doesn't mean they're not going to go down. It just means what they should do based upon all the data that I'm staring at.
Gotcha. So then with that being the case, we are also saying that the affordability of home prices should be adjusting downward. They are not. So are we in a recession? Are we at another bubble? Are we at another crash? Because again, some of these things just don't seem like they really belong together, if you will, in a normal cycle.
We're definitely in a recession. Let's not even argue that. I think that it's been redefined by our current administration and the people who are supposed to be, kind of understanding and I would say in control of the economy. I don't say that they're in control, but at least defining the economy. The definition of the recession has changed. We've been in a recession for a longer period of time. If you take all the traditional definitions of it, we've been in one and we are in one now. And then you have the fact that the cost of everything going as high as our inflation is completely underestimated. And one of the ways that a lot of people, I think, fail to understand, there's a plus and a minus to inflation, right? The plus is your dollar, if you set your expenses for a long period of time, is going to make you money. But if you're set to have to pay the expense on a month-to-month basis, you're losing money with that dollar. Right now, keeping your money sitting in the bank account, you're losing money. You're losing about if we want to take an average inflation since the 80s, you're losing about 0.6% per month on the value of your dollar. So that's significant. That is very significant. So letting it sit there in cash is not good.
But then, other than say maybe an emergency fund to, if anything's out there, what you're saying is that people, if they have a significant amount of money in savings, probably should be using that some way and putting that to use right now, because they'll do a lot.
Somewhere, yes.
Invested somewhere. Okay. So then where do you see us going now? You ended with a question about the big hedge funds, buying up everything, and they bought about 41% of the single family homes, if you will, in the last period or so. And so you said by 2030, they should have what percent again?
Approximately 40%. It should be 40+% of the single family rentals should be anticipated to be controlled by the hedge funds or Wall Street.
So there's been a significant effort, as I understand, people who have been talking about moving to a non-owner economy, but more of the sharing economy. So, for example, Uber or Airbnb and those kinds of things. That's the
Split.
economy.
You got pad splits making a big run.
Pad split. Okay, that's a new one. Okay, and I know.
Have you heard of pad split?
No, no. Talk to me about that.
That's taking a house, let's say a 3,000 square foot house, and cutting it up to where multiple people live it, share the kitchen, share the bathrooms, but the bedrooms are set up like little mini suites, right? And so each person, instead of having to pay the $3,000 a month for the house, they each pay like $800,
Gotcha.
right?
So
So
then,
that's a pad split. That's becoming a big deal in Northern California, other parts of the country.
yeah, I've heard it under different names. I've heard house hacking as being the same thing, exactly what you're talking about. And a lot of people are saying if that's what you want to do to get into a home these days, do that, get the larger home and then, rent out the other rooms or say the upstairs or the basement to someone else as a way of being able to generate income.
Well, there's been certain cultures that have done that all along, right? I mean, if you look at the Hispanic culture coming into the United States, you would see a full 2 or 3 families moving to a house, right? Then they would pay for it together, then take over the next house, and literally just start to control a block as people are moving into the area. It's a cultural thing that's been done before.
Yeah.
Now we're just literally incorporating a cultural thing into as a necessity for us to operate within our extremely high cost environment that we're in right now.
So then you mentioned earlier in our conversation, hey, you're not against multifamily, but you think the single families are probably a better way to go if you're talking about doing some investing right now, because you'll be competing, you'll have a long lasting potential investment that compete against the bigger people, right? The big hedge funds.
So it's two things. It's easier to get
Okay.
into, right?
Okay.
I mean, it's very, very simple to get into. There's lending 30-year fixed loans available to your average person to be able to buy an investment property. Very simple, very compared to buying a multifamily. Now we can go up to 4-unit buildings with that conventional financing. The other thing is it's easier to unload if you need to. Divesting of something, the exit strategy is something you need to be able to weather. It's easier to exit a single family than it is to say a 50 or 60 unit building.
Right.
Now, I'm not saying you don't want those, right? That's an eventual or gradual thing. But if a person wants to get involved in investing now, putting 10 single families in your books, very, very smart thing to do. Grant Cardone recently, and Grant Cardone is the king dingling of all things when it comes to multifamily. He came out just in this last week, literally it was last week, where he said publicly, expect rents to double over the next 10 years.
Wow.
So if you don't own investment properties, single families, anything right now, look what's going to happen to you if you are a renter, right? So that should be a massive alarm to somebody. If you're like, hey, I'll just rent until the costs come down or the rates come down. That's not a smart thing to do. Because if they're anticipating, a guy like that's anticipating rents to double for the next year, you're missing out on opportunity. And if you think interest rates have to come down to make that an opportunity, that's a bad move. So I'm going to do some quick math to explain why this is a bad move. So we're going to look at a $200,000 single family purchase.
Got it.
We're going to say it's 20% down.
Okay.
With a 30-year fixed interest rate.
Okay.
And we're going to say you've got $1,800 a month in rent on this thing with $100 a month in cash flow. Okay. Now, you as an investor-minded person, does that sound like a deal you'd want to get in? $100 a month cash flow on a $200,000 purchase, you're putting 20% down?
100% cash flow. I mean, $100 cash flow. I mean, it doesn't seem like it's worth the squeeze. Generally, I've
heard what most people say.
$300 a month or more is what you'd be looking for in terms of a positive cash flow on a single family house. But it sounds like it's a good idea. Maybe.
Yes. Your initial thought's going to say, nope, hell no. I'm putting 40,000 down on this thing.
Exactly.
Plus closing costs. Let's say my costs are 5 just because of that particular time. Let's say you're 50 grand in this deal. I'm making $100 cash flow. That is not a good cash on cash return. That's a shitty cap rate. I'm not moving forward. Well, I'm going to tell you why you should look closer at this while the rest of the world's going to react like you just did. It's like, it doesn't sound like a good deal. Because you want them to think that way because you're going to think differently. So we got a single family. Now, what I tell everybody, if you're the CEO of your real estate investment business, what you really need to worry about is, one, who you're working with that's going to help you maintain that property, make sure it gets done. Yep. And is it one you can keep reasonably rented the entire time you own it? And will it appreciate? If you can do that, who pays off the $160,000 mortgage?
Your renters are paying off all of that money. Yeah.
Exactly, your renters. So let's take 160,000. This is where the math's going to kick in.
All right.
160,000 divided by 30, because that's how many years it's going to take your tenant to pay off your mortgage or series of tenants.
Mm-hmm.
So 160,000 divided by 30, what do you get?
Got it. Let me pull up the regular calculator now. I went to my
Oh,
was that my
your
mortgage
calculator is like, yeah, I'm doing it serious. I got the HP out.
So we've got $160,000, $60,000 divided by 30.
Divided by 30.
Well, this is saying 5,333.
So that means averaged over 30 years. Again, there's an amortization schedule. We're saying on an average, you're holding this for 30 years. That means your tenant is whittling down that note by an average of $5,333 per year. And you invest in 50,000, right? 40,000 down, let's say plus 10,000. I'm saying that's what it is, but it's round numbers. So what percentage of your 10,000 is $5,333?
What percentage of my
$50,000 investment?
$50,000 investment. Okay, this is.
So you got $5,333 basically giving you every year by paying down the note, and you invested 50,000. So what percentage of that 50,000 is 5,333?
Let's see. We've got about 9.33. I think that's
actually 10.6.
10.6. Okay. So then I got to go back and look at my.
You do 5333 and you divide that into the 50,000.
That's right. So I did it the other way around. Yep. Got it.
Just flip it, right? So 10.6%, that means your $50,000 investment, just by having somebody pay off your notes, increasing by 10.6%. Pretty significant. Now, that's just that. Now, we said that we live in an inflationary environment. That means property values are going up. You know how much they're going up by right now?
Got it.
So we had Case-Shiller, CoreLogic, and I can't remember the other one. Came out this last week and said we're about 6.3 to 6.7% year-over-year increase in housing costs as far as the price of the housings. So we're going to cut that in half. Let's say 3%. Or no, you can cut it down anymore. What's 2.5%? What's 2.5% of 200,000? You bought a $200,000 house. It will appreciate by only 2.5% in any market. And I think that you'd be hard pressed to find a market, at least that's worth investing in, that won't appreciate a hell of a lot more than that. But let's just say 2.5.
2.5% per year would be what? $5,000 on the
$5,000. So your house is going to go up by at least $5,000 per year. At least. What percentage of 50,000 is 5,000?
What's that? What percentage of 50,000 or 5,000 is 50,000? 10%.
10%. That's another 10%. So a tenant paying off your mortgage is 10.6% of your investment of 50,000. The house going up by 2.5% of its value is at least 10% of your 50,000. You're at 20.6% increase on your investment every year, not even looking at a single dime of cash flow yet.
And you're getting. Go ahead.
I say, do you see how valuable holding real estate can be? Just holding it.
So then, somebody will say, well, I thought I was getting involved in investing just so I could make money, I could make cash flow, because that's the big thing. It's growing in value, but I'm not seeing anything. But you are getting the tax benefit from it. Right.
Well, we will get there. We'll get to all those kind of things. Because some people say, well, what about, but how many people put money into a 401k or an IRA or a mutual fund and haven't seen a single dollar hit their account, but they love opening that statement, say, look at how badass I am. Look at how big my investment balls are today.
Got it.
Well, you can do the exact same thing. The problem is nobody's lined this out on their investment breakdown on their real estate. So we'll move forward on the cash flow. So we talk about $100 a month, right?
Sure. How
much are rents going up by year over year right now?
They'd say it depends on the market, actually, but I'd probably say about 3 to 4% at least.
3 to 4%. And that's, again, if you're averaging in some of these markets are taking a beating. But if you're sticking with the South and the Midwest, you're probably seeing 6 to 7. I've seen some do 8 to 9. If you go to Miami, it's like 30. But let's just say 3. Let's go at the bottom end of what you're saying. Yep. Let's just say 3%. We said we were renting this place out for $1,800, right?
Okay. That's the $200,000. Okay.
Yep, $200,000 house, renting it for $1,800 a month with $100 a month cash flow was not exciting, but you raised that $1,800 by 3%. What's 3% of $1,800?
3% of 1,800. See, 1,800 times 0.03 is 54.
$54. Nothing extreme, right? That's not a huge raise. Nobody gets excited about $54. But what's most important is your tenant doesn't get excited about $54. There's people right now in apartments that are seeing $200 a month increases year after year. If you have a house you rent to somebody and they're a good tenant and you raise the rent by $54, they're not going to bitch.
Right.
Well, what you now have seen that your $100 a month rent or $100 a month cash flow just went up by 54%. You're getting double-digit increases in your cash flow. After 4 or 5 years, you start to see, okay, now I'm getting to that $300 and $400 and $500 a month. It starts to come. But people walk away from great deals because of what they see for year one, not thinking about 3, 4, and 5. Now, this is not where it gets sexy. So we're talking about a payment on this place of about $1,170 a month.
Mm-hmm.
So
that's
we live in place
PITI, that PI, but that is not
P&I, correct. That's principal and interest. So you're going to pay over 30 years on this with your tenants' money about $407,000 in principal and interest on this $160,000 loan. Okay. Your average human is going to go back to what Grandpa said and what Dave Ramsey said: pay off your mortgage, pay off your mortgage, pay off your mortgage. I'm going to tell you right now, those who are listening, don't do that.
Why?
That is a great thought process for certain people, not for a person who wants to invest in long term. This is why we talk about the inflationary environment we lived in. What's happening to the value of the U.S. dollar, the spending power of the U.S. dollar every single month?
It's dwindling.
Dwindling rather fast. Let's go back 30 years ago. 1994, I quoted 93, but I was wrong. It's 94. I walked into a Taco Bell for the first time in Moses Lake, Washington. I saw on their value menu, I can get 2 bean burritos, 2 tacos, and a drink for $1.99. Fast forward to November of 2023. I'm driving through a drive-through in Mesa, Arizona with my daughter. I had to take her back to school for an after-school thing. She goes, hey, let's just go to Taco Bell. I said, what do you want? It's not a value menu anymore. She wanted the 2 bean burritos, 2 crunchy tacos, and a drink. What did I pay?
$15.
$15 freaking dollars. That's exactly what I paid. It's $14.99. $15. That is a 750% difference in 30 years. 30 years. So that means the dollar spent is 750% differently. Now go back to the 1920s. 1920s and before, I have 2 of these, a 1 ounce gold piece. It was minted as a $20 gold piece. $20 is all it was. I could walk into a department store if I was alive back then and get a hat, a suit, a tie, a shirt, a belt, a pair of socks, and a pair of shoes for that $20 gold piece. I can't buy the damn socks I'm wearing right now for $20. But what's interesting, I could walk into a department store and get all those exact same things for 1 ounce of gold. The gold has not gone up in value. The cost of all those items have not become more expensive. What we exchange it for has become worth less. So when you break that whole thing down and you reevaluate the value of the dollars that leaves your hand to pay your mortgage every single month for 360 months, you're not paying $407,000. You're paying approximately $154,000 in dollar value over that period of time. The bank loses money when you stretch it out. You're raising your rents. Your tenant's paying off your mortgage. Your property's going up in value. You get tax benefits, and the bank loses about $7,000 on you. That's why you don't pay it off.
So then my question is, then, if the rates go back down again, do I refinance so that I can increase my cash flow, or should I just let it ride as you are indicating here?
What I encourage everybody to do, if the rates go down to that point, here's 2 things. One, if you're sitting on a 7.5% interest rate, 7.6% today, 1, it doesn't freaking matter. 2, if it goes down to 2%, which I highly doubt it will, and I'll show why here in a minute. If it does, I'd say do it just so you can put the damn thing on your headstone. Some bitch got 2% a second time around, right? Why not? Right. Because I don't know if anybody's ever going to be able to do it again. You got to do it twice in your lifetime. That makes you different than everybody else in your lineage, right? You're going to be like the Viking king. But if you're talking about refinancing period, I encourage it in only one environment really is to pull cash out to reinvest it. Yeah. The reason being, what the average person in the United States, and it could be a little bit off on this, but it's about an average person refinances their primary residence in the United States.
What's it, 5 to 7 years?
About every 5-6 years. So I had a client. What does the first 5 years of your amortization table look like?
In terms of the principal, it stays. It's pretty straight.
Pretty minimal, right? You're paying almost all this interest. And what's really funny is it's for the first 5 years, it's all interest, but people keep refinancing. Well, it's all interest. So I have a case an example here. I had a client of mine come to me. He started with a $120,000 mortgage. Came to me and said, when rates were lower, he said, "Hey, I want to refinance this." I'm like, "Well, how much cash do you want out?" Because all my clients pull cash out to reinvest into more investments. It's like, "No, I'm just refinancing it for the rate. I want that lower payment." I'm like, "That's not a smart thing to do." He goes, "My dad always said to do it. My other banker that I've known forever, who just retired, said to do that, and he's not going to do the deal, so I want you to do it." Well, I showed him that he had paid almost $38,000 in payments over 48 months, but the balance had only dropped like 6,300. Like, you realize you put 38,000 out, but only dropped 6,300. The bank just made 30 plus $1,000 on you, and you want to refinance. He goes, "Yes, I want to refinance." I couldn't talk him out of it. Well, what does a person do with the new costs when they refinance their house? They got costs. Where do those costs usually go? How do they get paid?
They wrap them into the to the cost of the loan.
Wrap them into the mortgage. Well, by the time he was done wrapping those costs, his new balance was within $122 of his original balance. So he reset his mortgage back to approximately $120,000 and did it for another 30 years, and he was happy. If he kept doing that every 4 to 5 years, as the pattern is, let's say it's 5, he'll have paid over $180,000 in payments to the mortgage company, but never dropped his balance. That's why they're so encouraged to worry about interest rate. If the guy next door to him had a 7% interest rate and paid on it for 30 years and kept paying on it, he'd have been 3/4 of the way done. Or this guy in 20 years, or he had a third of the way done, where this guy in 20 years had paid more than he paid for the house, but never moved his principal.
So then, question: if somebody is sitting on an investment property at 7.5%, and pretty much you're like, "Hey, just stick it out," but there's equity there because again, the prices, the cost, the value of the house has been appreciating over time. So there's equity there. Should they just do a HELOC on this investment property, or what do you think they should do?
I would pull, if there's enough in there, I'd pull enough. I always look at, can you buy a couple more houses with it? Because if you can, I would definitely pull it. I wouldn't worry about a HELOC. Some people are like, "Man, but I got a 3.5% rate." Good shit. Will your renter in your tenant in this house and the tenant in the other 2 houses pay for the 3 houses? Well, yeah, they will. Okay, then. So if you pulled money from house number 1, and that money you got doesn't belong to you, right? It came from the bank, and you reinvest it in 2 more houses, and those are going up 10%, right? Just on the amortization, but it's really not 10% because it's not your money. And then they're growing by 10% again because of the 2.5%. But again, it's not 10% because it's not your money. You're getting an exponential growth on these because you didn't invest a single dollar into it. Your cash flow may have dropped, but your cash flow will catch up because you're raising rents now on 3 properties instead of just 1.
Right.
And now you've got 3 assets growing for your family, not just 1. And the other part is you didn't use a single dollar of your money to do it. And then you get to write off a higher interest on your taxes that you don't even pay. So you got to run the numbers. There's a lot of people out there to get this belief that I'm going to take my $100,000, I'm going to pay cash for my house because I'm going to make more money. It's going to have more cash flow. Sure, that's possible. You buy a $100,000 house that's renting for $1,000 a month. You can make $700 a month cash flow. Makes sense. But what if you could take that same 100,000 and with $25,000 buy 4 houses, so 25,000 a piece. Now they're all renting for 1,000, and you're only making $150 a month cash flow. How much is that 150 a month times 4?
Yeah.
You're at 600. Now it's not 700, 600, but then you raise the rents, right? Raise them by 3%. 3% of 1,000 is what? $30.
30, yeah. And go ahead. 30
now
times 4.
Yeah, exactly. Now you get 30 times 4, right? Now all of a sudden you're passing the 700, the other one. The other cool thing is these other 4 are growing at that 2%. And you got the pay down on the mortgages where you don't have a mortgage paid down on the one. You are not making near the money without leverage on paying cash for a house. When people pay cash, they screw themselves. When they use the bank's leverage and somebody else pays it, they compound their growth significantly. Now, we talk about legacy as leaving money. I talk to a lot of my clients that say, I'm trying to save X amount and try to set aside some money for my kids. I'm like, why? I mean, you're buying houses, you don't have to they're going to have all that. How about you take this capital you have say $100,000 in your bank account, buy a whole life policy. That's what I did. And I'm speaking from experience, not trying to sell people on whole life. I don't sell it. I have people that sell it, and these guys are awesome at explaining it. I just use it. So I bought a whole life policy. Then I take the money from that whole life because I can borrow against it like a credit line, and I buy real estate. And I take the cash flows from that real estate and I knock down the mortgage. I mean, the loan on the credit line, and I do it again and again and again. Well, when I die, my family will have houses and death benefit. If I took it from a bank account, my family would have an empty bank account and houses. But if I take it from a life insurance policy, I have life insurance policy, massive death benefit, and a bunch of houses.
Yeah. And then the cash flow is continuing to add to your bank account at the same time, which then goes back to my bank account.
I use the cash flow to pay down the life insurance line of credit, but if I don't want to pay the line of credit, I don't have to. That's the other cool thing about it. There's enough cash value there, or there's enough death benefit that I never have to pay it back. I can just use it for myself.
Because, and I've just been watching some videos on this where people have been using whole life instead of because I think Dave Ramsey and others say buy term and invest the rest, instead of doing a whole life policy. So when you bought that $100,000 whole life policy, when did you actually tap into, getting this credit line after you got the policy?
So I bought the policy early 2017. I started the process of acquiring it in October 2016. As soon as I closed on it, within 3 weeks, I was able to draw. So I paid $90,000 for the policy. I drew $83,000 out within 3 weeks and bought 3 real estate properties, 3 investment properties. So it's a matter of who you're talking to. The problem with Dave Ramsey, and I love Dave. A lot of people say, well, that guy doesn't know what he's talking about. The hell he doesn't. He's got an amazing market. He's got an amazing group of people. He knows his niche, which is the biggest niche in the world, which is people that are freaking broke. So the guy's got the greatest niche there is. He's made a fortune off of it, and he's helped a lot of people get out of debt that wouldn't get out otherwise. It's all these other people, well, there's this higher thinking. Well, he does the higher thinking. That guy's leveraged beyond any of us. He gets it. He's a smart man. So, but he teaches people how to get out of debt because that's even more crushing than learning and understanding leverage. So I have huge respect for Dave. When you're talking about the life insurance policy that's out there, he says, buy term and invest the difference. Well, let's also talk about the life insurance salesman. I would say when I heard one of my closest friends and a big client of mine, he was at the time he worked at the Pentagon. Then before that, he was an instructor at the Naval Academy. Before that, he was the captain of the USS Tucson nuclear submarine. I heard he left the Pentagon to sell life insurance. I thought this guy was a freaking idiot. So I called him up to ask him why he was so damn stupid. Well, then he explained to me what the whole life policy actually did, and that's why I closed on one. The misconception I had was, and understood the buy term and invest the difference, because every policy I bought before that, I got screwed on. It'd take a year or 2 years to get any cash value out of it. Do you want to know why it takes so long to get cash value out of the policy?
That's a good question. Yes.
Because your average life insurance salesman, when he sells you a life insurance policy, him and his brokerage get nearly 90 or 100% of your first year's premium as their commission.
Got it. So it takes year 3 for you to be able to even tap into
any cash value, because they took that from you and said, okay, we're going to insure your life, but we're not going to give you any cash back until you put more cash in it. Now,
that's why you amassed a lump of cash to put into a policy, right? You spent $100,000 for a whole life policy that's maybe $1 million or something like that, right?
Yep. You're buying $1 million of death coverage, but somebody else is getting paid that $100,000. So with these guys, though, I put in 90,000. I had 83 available. Why? Because they only take a little bit for a commission. Still a lot of damn money, right? It's like 7 G's goes out somewhere, but it's not 90 G's. And so that I was able to use that money right away. And I had a $2.7 million death benefit. So that's the difference. So I had to have 7 policies. I got 2 on me, 1 on my spouse, 1 on each one of my children. Every one of my married children and their spouse. And they all participate in the family trust, and we buy houses, and they all rent from the family trust. So that's how our family's set up. And I started setting it up in 2016. And I've got 3 kids that are married in different parts of the world. I've got a friend of mine heard me on a podcast talking about my 7 policy, and I love this guy. He has one of the biggest life insurance firms in Arizona, wealth management and insurance. He goes, dude, I heard you on a podcast. You got 7 life policies? I'm like, yeah. He goes, how come you didn't call me for that? And I said, let me tell you about the policy. And as I explained it to him, he goes, oh, yeah, we don't sell those. I'm like, why is that? He goes, because they don't pay any commission. That's why you don't hear about it. That's why buy term, because the life guys stick you in the ass. The term guys get just a tiny piece. Well, I don't know if Dave knows about the other one, or it's not broadly used or broadly talked about, the infinite banking strategy, but the people don't talk about it, because if everybody knew about it, they wouldn't buy the other ones.
What's the name of it? I mean, you're talking, you're doing really good here with that sales. It's like a salesman thing. What is the name of that policy?
Oh, it's the guy. Bring him on your podcast. His name is Gary Pinkerton with Paradigm Life.
Done. We'll be reaching
That's
out
that's
to him.
the, that's the. I'll connect you up with him. That's the guy who left the Pentagon, which I thought was an idiot, to
Oh,
become, to me, one of the worst. And this is actually, this is a compliment. It's not going to sound that way, but one of the shittiest insurance salesmen on the planet, but one of the best educators on the subject.
I understand.
That's why he does so well. He does not sell you on a single thing. He actually educates you.
And that goes back to Dave Ramsey, because I remember one of his key items was always work with a vendor or a team member that has the heart of a teacher. So if you have somebody who's the heart of a teacher, that's the person that you want to go with. So definitely, I'd be open to talking to Mr. Pinkerton here. So where are we going? I mean, we've talked about kind of where we are, kind of how we got here, kind of what's happening now, but where are we going? I mean, you've talked about how the big boys are buying everything, and 41% by year 2023 or 2030 will be rentals. What else do you see? The reason why I'm asking is I was just watching another YouTuber in Atlanta, Georgia, and there were 3 Walmarts that were closing, and they were at the 25 percent. Then they would go to 50% and 75%. He walked in with his video camera at 25%. The counters, everything was wiped out. People had wiped out this Walmart, and he intimated, hey, we're in a recession. And you've indicated, hey, we've been in a recession for a long period of time. I've been shouting that on this podcast along with other people who've been here, but we have not seen the recession crash, if you will. What are you seeing moving?
We haven't seen it. That's going to come when it's going to come. So what I want to share with you, because everybody's worried about the rate. Let me just share a screen with you real quick if I can. No,
Sure.
I need to make me co-host so I can share that. So where we're heading, we are heading to higher for longer. We're heading to increased inflation. We're heading to increased cost of housing and higher interest rates. It just has to happen that way. Everybody's waiting for the Fed to lower rates. The problem is the Fed lowers them too quickly. It's going to push inflation through the roof. We also have there's even more when we start getting into Freddie Mac going to start guaranteeing second mortgages. Where's this money going to come from, right? More money that goes out there, the higher inflation gets. If they're going to offer second mortgages so people can tap into the equity, and they tap into equity just so they can spur this, get the economy cranking again. We don't have enough jobs. Too many people were cooking the books on jobs. They're trying to say the job economy is doing great when it's really not, because people are having to have 2 and 3 jobs. You have an administration that wants to get behind saying, hey, we just did an amazing thing for jobs. No, people went back to work after COVID, after your dumbass shut the whole sumbitch down. So there's that problem too. Well, let me get into where we're going. The interest rate thing real quick. What people fail to or don't understand is where interest rates come from. Have you ever seen the movie The Big Short?
Absolutely.
Okay. The Big Short talks about the mortgage-backed security. That's what caused the big problem. So mortgage-backed security was just a big place where people would throw money into, and then everybody borrow from it on a grand scale, right? You had a pension fund that was illustrated in the first part of that movie of them investing $25 million. Well, it used to be the banks would do it locally. Now we're doing it globally. Well, this shows the mortgage-backed security for the last 13 years, actually a little bit more than that. We're back to 2008. It's now what's that? That's 15 years. So when the market crashed, the Federal Reserve came out. It was Ben Bernanke with the assistance of Hank Paulson, who was the Treasury Secretary, said, we're going to do quantitative easing, which is a fancy word of saying we're going to print a bunch of money and we're going to buy into the economy, which is through mortgage-backed securities and U.S. Treasuries and corporate bonds. So right here is when they announced it. They announced it right there. So everything before this was the mortgage-backed security operating on its own here and back. So it always stayed in this range or even lower, because the lower it goes, the higher the interest rate is. This shows the supply of money. The higher this chart goes up means the supply goes up. The lower the chart goes, the lower the supply, meaning the cost goes up. So it's supply and demand thing. Right here, this yellow line, I drew this, which was November 25th. Was it? Yeah, I think it's November 25th, 2008. The Federal Reserve came out and said, we're going to do quantitative easing, meaning we're going to put money into the mortgage bonds. Now, Jonathan, if you and I were sitting at, let's just say, a Waffle House, And a couple guys in suits come walk in and sit next to us, and they talk about putting $1 billion into a specific stock. What are you and I going to do the second they leave?
You're gonna go and run and throw some money in there too, but you know what
Call
I
our
mean?
Schwab guys right then and say, we want everything we have over here. We're going on 26 red, man. We're going to put it all right there.
Spin it.
That's what the market did. And it jumped from there to this line here. This is where the Fed started putting money in. Look at all that liquidity. Now, just so I can illustrate, look at just one of these little tiny lines here. If you can see that little tiny line, that's 1 day's worth of trading. Actually, It represents a week's worth of trading. This happened from November 25th to January 1. That's what happened in a month. Billions went into the market. And then the Fed started putting in there. This represents all in with the market, people jumping in with the Fed, all this capital. This is why I had interest rates in the 3s and 2s. Then you have this date here, which is October 23rd, 2021, or no, October 12th, 2021. The Fed announced quantitative tightening, meaning we're no longer to put money into the market. What happened? Fell off a freaking cliff. So you fast forward to about 6-8 months ago, where people were asking me right around here, when are we going to get the rates go back down to 3s? I had to go back and look, and that's when I stretched it out to 2008 and said, what was the market value of this security before the Fed did quantitative easing? And that's where I found where the lines I showed you, which puts the value right in here. But we were bouncing along this, and with the 200-day moving average was the day that what I was watching. That's what this blue line is. And I'll zoom in on this 200-day moving average. This is where I was telling people, hey, lock when it hits that average and float when it goes below, because it's going to bounce off that average, bounce off that average, bounce off that average, as it did. But then I started looking at it at people's requests, and that's when I drew that yellow line across and said, I think when we get below that definitively, we will never get back above it again. And that's what I was watching, getting below this yellow line. See how it just kept bouncing off it, bouncing off it, bouncing off until it finally broke below. And when it broke below that, and it broke below the 200-day moving average significantly. Look at where we're at. It continued to go down. Now, here's where they kept saying, oh, the jobs are really doing very good. We've got all these jobs being created. That was actually people going back to work after COVID. That's why this kept going down. And in October of this last year, they really started to report jobs a little bit more accurately saying, we're actually losing jobs. Jobs aren't near as good. That's a signal to the bond market that, the weakness in the economy, people are going to go to bonds. So what did they do? Shoving money back into the bond market. And where did it end? It ended right on that yellow line. Bounced off it, and came right off it and continued back down. That, to me, is our ceiling, that yellow line. And as it continues to be our ceiling, we are not going to see interest rates get lower than what they got in February of this year. That's my anticipation. And I think that we're going to see interest rates continue to follow these trends down till we get down in here. And I actually have a prediction here from a bond trader. I mean, this guy is a stock trader. He is a day trader. He looks at what they call price action. He predicted, he's saying this is where there's liquidity, where people will actually have a lot of sell orders. They sell off when it hits here, which was proven. They sell off. Then we're going to get here. He says we're going to bounce off that. Then we're going to hit this target, which we did. We bounced off that target, hit that target. And he's got another target here, and this is our final target. We're going to work our way down to here where there's a lot of buy orders waiting to pick up this security and go back up. This means our interest rates, this right here, the average person buying a house to live in is going to be over 8%. The person buying a house as an investment property is going to be over 10, but they will never give you a 10% interest rate like they did not here. Here in October of last year, the average person is getting 8.125, charging 2 to 3 points. Why would they charge them 2 to 3 points rather than just giving a 10% rate?
Well, they want to get their money up front right now rather than saying. Let me say why. Let me go why. It's been a while since I've done the mortgage game. Most of the time,
if I offered somebody 10%, and literally within weeks later, months later, they could get 7.5 with 2 points, what would they do? They would refinance, right?
Mm-hmm. They refi.
Well, I know you pay costs when you close on a loan, but when they close the loan and securitize it for you, they pay costs. It's about 2 to 3%, if not 4%, to securitize it, to do the audits on it, and prove that it was done legally, and then put it on the shelf. Once they do that, they only make their money back by collecting interest. But if they set you up at 10% and then 6 months later you refinance, what happened to all their money? They lost a lot. billions get lost. So what they do is say, we're not going to give them that. We'll give them 8 and an 8 and charge them 3 points. Because if the market goes down to 7.5, charging 2 points, they're not going to refinance for a half a percent and pay 2 or 3 more points. That's why. So there's some strategy in this. So you start looking at the market as a whole. I don't see us ever getting back to the 5s and the 4s and the 3s unless moved upon by massive amounts of capital, which would be the Federal Reserve dumping in trillions. Then what's going to happen to inflation? What's going to happen to the cost of housing?
Well, I mean, the cost of housing would continue to go up, like you mentioned before, right?
Scream to the roof.
Which then would support what Grant Cardone, you mentioned, saying that rents will double, if you will, in the next 10 years.
Rents are going to double anyway because of our current situation of not enough housing.
Got it.
And interest rates are still going to be slightly higher, and inflation being as high as it is. And look at the wages right now, wages versus cost. Inflation, the wages are not keeping up with inflation at all. And think about that. They cooked the books on inflation because of things like Social Security and pension funds and all that with the government. Well, it was all signed into law that they have to pace those increases with inflation. Well, if you recook inflation on how it's measured, they only have to move it up 2 to 3%. But the real rate of inflation is closer to 12 to 13. My dad would probably be getting $5,000-$6,000 a month on Social Security right now if they moved it with inflation, but they don't. They rewrote inflation in the 80s. The other thing is they took the money from Social Security and put it in the general fund and pissed it away on all the other stuff that they did. That's why we won't have Social Security by 2030.
That is what I've heard recently as well. So then buying single family home. Question, what about condos? I know some people are doing the condo Airbnb thing, short-term rental, blah, blah.
No, short-term rental is great. Condos are I'm very, very iffy on condo. If you buy a condo, get it financed and hold for 30 years, same principle. Here's the problem with the condominium. If you have more than 52% or 51% of it's less, if you have less than 51% owner occupied, it's impossible to get financed. It's very hard.
Got it.
To me, the name of the game is long-term leverage. That's how you win. Paying cash for stuff is you win, but not very freaking fast, right? It takes forever to win in that. Free and clear property, people love to sue you, that kind of thing. Being able to leverage is where it's at. Condos are hard to leverage right now, especially when you're talking about investors buying condos, people renting condos. If you're at a point where you have less than 51% owner occupied, you now have an apartment complex in reality. And not a lot of people are able to buy apartments except for how it's set up in like New York or something like that. So
I can understand that that's for FHA because FHA has the do not lend, and that's one of the stipulations. But for conventional financing, is that still the same way?
So conventional and FHA are actually very, very, very similar in what their requirements are. A lot of people think it's conventional. It's going to be easier. It's the same. You still have to have a certain amount of safety measures.
Right.
I mean, basically, the Department of HUD, the Federal Housing Finance Administration, as well as or finance agency, I think it is, and the Consumer Financial Protection Bureau have basically incorporated all the same things that FHA and VA and USDA have incorporated in looking at houses, because now these are government-sponsored entities. Once you have Fannie and Freddie got taken over in conservatorship, they're following a lot of the same rules. The only difference is loan to values and debt to income ratios are slightly different, how you underwrite it and how they guarantee it. But the asset itself has to still meet pretty much the same guidelines.
Got it. Okay. So then what are you suggesting that we should do right now? Because you've mentioned a very detailed strategy that you are following right now, but what should people who are interested in, doing anything right now in the finance world, some people are our podcast is the Strategic Multifamily Investing Podcast. You mentioned some positive things about multifamily. Before I go to that other question, let's talk about multifamily. What are you seeing in the market? What are your thoughts about it, et cetera, right now?
Well, I think multifamily is great. I'm involved in some out in Georgia. I think that multifamily is something. One is also two things. One, it's great if you get into it and you get into it right. It's a game changer for you financially and for your family's future. But secondly, it's also, if you don't know what you're doing, you get into the wrong operators, man, that's like going to crucify you really fast. So understanding who you're working with, it's the same principles. It's just a lot more. The consequences are bigger, both on the upside and the downside. Consequences are huge. right? Just like anything. So when it comes to a single family, consequences are a lot smaller. Multifamily, they're huge. So you have to be working with the right people, listen with the right group of people. But I also say cut your teeth on single family. You learn by doing. I'm one of those guys, I can read a textbook, I can watch a YouTube video, but until I actually do it, I don't understand it hardly at all. I have to go out there and put my hands on it. That's where learning by single family is a great way to learn on how to do multifamily. Multifamily is a graduated point where you want to get to. Most people want to get to, and I encourage everybody start one place and keep working towards the other, but never stop owning singles.
Question. You mentioned, I guess, again, at the top of the hour, that make sure that you get somebody who's pretty much a property manager, a good property manager that can manage these things for you as you're building up this portfolio. What is your rubric for saying what a good property manager is? And, if you could share that with us, how you select a property manager.
Well, you have to really get into their operation, understand who does what, who reports to it, look at their operational procedures, understand how do they vet somebody? That's the biggest deal. How do they vet your tenant? This is your asset, right? And is it an outfit that wants to vet it for the sake of just putting somebody in there so they get paid? What's their turnover like? So if you see a lot of turns on houses, I mean, these people probably suck at what they're doing. They're putting just anybody into that. You want to see averages of what's going on with the people that do have some turns. What does it look like? What neighborhoods do they recommend? I'd say talk to 2 or 3 different property managers. Look up their ratings, how people rated them, like your Angie's List or whatever else out there. Really understand what you're dealing with. Talk to your real estate professionals in the area. Who do they recommend? Don't just go work with a realtor whose brother-in-law is a property manager. It's usually a recipe for something that's not going to go so well. So it's going to be a lot of due diligence on your part to find out who does what. But me, it's looking. They can tell you anything what they want. Everybody can lie to you, but you got to see the numbers and see what's happening in their books and how often people are turning. Talk to see if they'll share with you some of their clients' names. So you can talk to them, find out what their experience is. But until you dig into it, you just don't know.
Now, you mentioned that you invest in a multifamily in Georgia, which is considered out of town for you. But what about investing in single families that are out of town for others? Are you all doing that? And how are you finding the markets that you'd like to be in, if that's the case?
I invest in single families in 6 states. And it's all dependent. I just look to see what states are really, really demanding the rents. Where can I get decent priced housing that I can put whatever work I need to make it work? A lot of it that I'm buying right now is for the family, right? We purchase houses in an area the family wants to live. We'll pay cash from assets, and then that's a whole other show where we use the family trust to buy it and use the LLC to fund it, and then we put a lien on it, and then I refinance it at a level that we need to for that the family member can pay it. Plus, we have a certain amount of extra everybody pays in, so we self-warranty. It's a process.
Yeah.
But it has to be an area I can make sense of. Believe me, we still have areas that I'm like, shit, I wish I didn't buy that house, right? We still have that, but it's still housing. It's still a solid asset. I still have something saleable. I'm still gaining value in it, but some of them are headaches. No matter how good you are, you're going to have headaches. What you need to have is a lot of good ones and a few headaches. That's the problem, because a lot of investors, they get into 1 or 2. Oh, these 2 are headaches. 100% of my portfolio sucks. Well, you need to expand your portfolio. I'm working with people right now. I got a lot of people that are sellers of real estate, new construction real estate with tenants, and they're, instead of using the marketing out there to spend money to market for clients, they roll through us and they buy down the rate for them. So I got people getting low interest rates on a 30-year fixed in a brand new build home with a tenant. I actually have that as something I can offer to even some of your listeners. Even though interest rates, in my opinion, don't matter, but if you can get a great one, get it. Just like we said about the other thing. Would you refinance it with 2? Shit, shy. Headstone. Not that I care, but I still get to say it. Same thing. But there's nothing wrong with expanding your real estate in any form you possibly can. If you can do long-term leverage, you always win. The banks lose.
Excellent. Well, listen, we always have one final question, and we've had you here for an hour or so. So this has been amazing. It's like drinking from a fire hose. I'm going to go back and rewatch this myself. But we always give people the boot, if you will. It's the last piece of information that if somebody, to spur somebody on to the next piece of action, the next thing that they should do, give us the boot.
You need to go to my website, KarenChapman.com, or you can go to just email me, aaron.chapman@snmc.com. I also have an app. When I showed you guys about how the time value of money works, I will send you an email with my app that you can download and you can calculate the payment for yourself and how inflation impacts that payment, how you're paying less than what you borrowed. Yes, just reach out to me, aaronchapman.com. Look for the bald bearded redneck lender, and I'm the only one out there.
There you go. Well, listen, thank you again so much, Aaron, for your time. And we look forward to working with you in the future and in communication. If there's anything that we can do here for you, please feel free to let us know.
Appreciate you, brother. Thank you for the time. And thank you, audience, for the listen.